In Florida, there was a company that appeared to have everything an investor might trust: a polished brand, professional contracts, luxury events, charitable sponsorships, monthly account statements showing steady profits, and at the center of it all, a simple promise: place your money into cryptocurrency liquidity pools and watch it produce remarkable returns. But in February 2026, federal authorities made a far darker allegation. They said the money was not flowing into a sophisticated investment strategy. They said it was flowing in circles. New investors paid earlier investors. Investor funds supported extravagant spending. And a business once presented as a financial opportunity had allegedly become one of the largest crypto-themed Ponzi schemes in Florida history. Its name was Goliath Ventures. And the question is not simply how much money disappeared. The question is how something this large could appear legitimate for so long. Goliath Ventures was previously known as Gen Z Venture Firm. According to federal investigators, its president and chief executive officer was Christopher Alexander Delgado, a Florida businessman who controlled the company while it attracted enormous amounts of investor money between January 2023 and January 2026. The pitch was built around a real concept from the crypto world: liquidity pools. In decentralized finance, users can deposit cryptocurrency into pools that help facilitate trades, potentially earning fees in return. It is technical enough to sound advanced and simple enough to be sold as passive income. According to the criminal complaint, Goliath told investors that their money would be deployed into carefully managed crypto liquidity pools, primarily involving USDC pairings on platforms such as Uniswap. Marketing materials allegedly described risk controls, monitoring systems, and disciplined strategies designed for qualified investors. But there was another ingredient: confidence. Contracts sometimes offered monthly returns ranging from 3 to 8%. Some returns were allegedly described as guaranteed. Some investors were told their principal could be protected. They could receive monthly distributions or roll the returns back into their accounts and watch the numbers grow. In a normal investment, higher returns usually mean higher risk. At Goliath, according to investigators, the danger was hidden behind the appearance of certainty. The company did not rely on anonymous advertisements alone. It moved through trust networks, personal introductions, friends who appeared to be earning money, professional presentations, private meetings, community events, charitable associations, elegant gatherings where investors could see wealth, success, and credibility assembled in the same room. One investor, identified in court records only as Investor 1, was introduced to Goliath through an acquaintance who claimed to have invested approximately $1 million and to be receiving consistent monthly returns. The offer presented to him was extraordinary: participation in cryptocurrency liquidity pools with a guaranteed monthly return of 7%. In March 2023, Investor 1 began cautiously. He invested $10,000. 1 month later, according to the complaint, he received approximately $700. Exactly 7%. That first payment mattered more than any brochure. It transformed a promise into something that felt real. More payments followed. They arrived consistently. Then came a formal joint venture agreement, signed on behalf of Goliath by Delgado, describing how funds would supposedly be placed into liquidity pools. In December 2023, Investor 1 attended a Goliath-hosted event at the Four Seasons Resort in Orlando. He later described it to investigators as extravagant and professionally organized, filled with attendees. The company did not look fragile. It looked established. Months later, he learned that Goliath was a major sponsor of a charitable organization. Through that connection, he met Delgado. For an investor looking for warning signs, public generosity can feel like evidence of character. According to investigators, it became evidence of credibility instead. Between mid-2023 and late 2024, Investor 1 put approximately $720,000 into Goliath through bank wires and cryptocurrency transfers. He believed he was building wealth. Federal investigators allege he was becoming trapped inside an illusion. The company gave investors access to online portals displaying account balances and apparent returns. The numbers looked precise: monthly distribution rates, monthly distribution balances, current totals. the clean language of finance, converted into a dashboard. But according to the criminal complaint, the displayed returns were not tied to genuine liquidity pool profits. They were allegedly calculated to match what each investor had been promised, creating the appearance of stable performance whether or not any real investment activity had produced it. And when investigators followed the money, the central promise began to collapse. Goliath allegedly raised at least $328 million from investors under the representations described in the original criminal complaint. Yet, blockchain analysis cited in that complaint showed that approximately $1.5 million was sent to Uniswap. Not $300 million, not $100 million. Approximately $1.5 million. Investigators alleged that the vast majority of investor funds never reached the liquidity pool strategy that had been used to attract them. Instead, money remained in bank accounts, moved into crypto wallets, paid purported returns to earlier investors, covered corporate spending, or supported luxury purchases. From January to 2023 through June 2025, investigators said approximately $253 million entered one J. Morgan Chase account connected to Goliath. Another $75 million allegedly entered a Bank of America account during part of 2025. More money flowed into Coinbase wallets. The movement created the impression of activity. But movement is not profit. According to the complaint, around $50 million from the J. Morgan Chase account and approximately $11 million from the Bank of America account were sent to investors as purported returns. Investigators alleged those payments primarily came from money supplied by other investors, not from investment gains. That is the architecture of a Ponzi scheme. The people receiving money early may believe the system works. Their successful withdrawals become testimonials. Their confidence attracts others. The fraud does not survive, despite the payments. It survives because of them. A second investor shows how powerful that illusion could be. Investor 2 allegedly met Delgado and a Goliath representative at an Orlando restaurant in July 2024. The following month, he invested $1 million at a stated monthly return of 5%. Then, in December 2024, he invested an additional $15 million under terms that promised 7% monthly returns for 6 months, followed by 7.5%. At a Goliath Christmas party, Delgado allegedly announced that the company had secured insurance and a Fidelity investment bond covering investors' principal. Investor 2 asked to see the documentation. According to the complaint, Delgado declined. That moment appears to have broken the spell. Investor 2 asked for his money back. After an email exchange in which Delgado allegedly expressed displeasure over the withdrawal request, Goliath ultimately paid Investor 2 approximately $17.7 million in February and March 2025. He got his money back, along with promised returns. But investigators say those payments did not prove Goliath was legitimate. They proved how an alleged Ponzi scheme could keep breathing. While some investors received large payments, others saw a very different ending. By late 2025, according to prosecutors, withdrawal requests were being delayed. Investors were given explanations involving audits, banking issues, and compliance matters. The reasons shifted. Supporting documentation did not appear. Investor 1 was told payments would resume around December 18, 2025. They did not. In January 2026, he requested an exit from Goliath and sought approximately $862,000 in principal and claimed returns. According to the complaint, Goliath represented that the money would be returned. It never arrived. After he contacted his bank and filed a police report, he was allegedly challenged by a Goliath representative over his efforts to recall funds. By the time investigators interviewed him, he said the company had stopped responding and blocked his access to the investor application. His alleged loss: approximately $720,000. At the same time, investigators were examining what the money had purchased. The original criminal complaint alleged that investor funds were used in connection with 4 Florida residential properties, including an $8.5 million home in Windermere, a $3.2 million property in Winter Park, a $1.65 million home in Sanford, and a property in Kissimmee. Then, the scale widened. In May 2026, the Department of Justice announced a civil forfeiture complaint targeting 7 real properties and 11 vehicles allegedly purchased with proceeds of the fraud scheme. In that later filing, the government alleged that Goliath had obtained at least $400 million from more than 1,000 victim investors. $400 million, a number larger than the one that first defined the case. The assets the government sought included luxury Florida real estate, office space in Orlando, Rolls-Royce vehicles, Lamborghinis, a Bentley, an Escalade, and other automobiles prosecutors alleged were connected to investor money. By then, the image of Goliath had inverted. The luxury that may once have helped convince investors the business was successful had become part of the evidence federal authorities were trying to seize. On February 24, 2026, Christopher Alexander Delgado was arrested on a criminal complaint charging him with wire fraud and money laundering. If convicted on all counts, he faces a maximum penalty of 30 years in federal prison. But this is essential. A criminal complaint is an allegation. Delgado is presumed innocent unless and until proven guilty in court. The government must still prove its case. What is already visible, however, is the human pattern. A promise wrapped in technology. Returns that looked reliable. Social proof created by real payouts. Trust strengthened by parties. Sponsorships, contracts, and digital dashboards. Then, when too many people asked for their money back, explanations replaced payments. That is why alleged schemes like this can grow so large. They do not begin with panic. They begin with belief. For the victims of Goliath Ventures, the most painful question may not be where the money went. Investigators can follow accounts, wallets, properties, and vehicles. The harder question is how trust was converted into evidence against them. A payment became proof. A luxury event became proof. A charity connection became proof. A portal balance became proof. Until one day the proof vanished, the withdrawals stopped, and the house called Goliath was no longer a symbol of strength. It was the place investigators began searching for what remained.